And so you ask yourself those questions. Does it offer safety of principal and a satisfactory return? Well, let's take a look at that as far as gold. So, safety of principal, does it offer a safety of principal? Well, it seems to be the case based on long term. I mean, one of the first things what we said in this video is that long term gold has held its value, and other currencies and other different investments have not, as well as gold has. So we can check that box kind of right from the start that yeah, I mean the safety of principle can be there with gold. Now gold has been quite volatile in the long term, and the prices of gold are only determined by the supply and or demand of gold itself. There is no underlying fundamental to gold to which you should say purchase gold. And so given that there's not a profit, or that there's not sales, or that there's not inventories, or that there's not assets and all these types of things, putting that value on gold is not possible. So it's simply supply and demand based on market sentiment, and that does make gold quite volatile. And given that fact, there's really no reason to say that gold should remain stable over the long term. You can't assume that it's going to, even though it has held value in the past. Why should it hold value moving forward? The only way it's going to hold value moving forward is if investors keep treating it the way that they have treated it, and flock to it in times of high inflation or economic uncertainty or things like that. So safety of principle, maybe, yes, we check the box, but there are reasons to believe that in the future, maybe not. Now, what about a satisfactory return? So over the longer term, stocks specifically have handled gold as far as the long-term returns. Now, that wasn't necessarily true in the 2000s, so 2000 to 2010, because we talked about how the price of gold tripled between 98 and 2008, and we had the Great Recession in the 2000s as well as from 98 to 2008, you also saw the tech bubble burst. So the stock market had a tough go of it, but gold did really, really well. But over the longer term, stocks have really given it to gold as far as getting those really good long-term returns. So just for your knowledge, and so we can know the basis on which we're talking about this, let's talk about their long-term returns. Well, over the past 100 years, this is what we've seen from stocks and gold. So over the past 100 years, the S&P 500, the basic index for the stock market, which is the 500 largest U.S. companies that we've talked about quite a bit, the S&P 500 has cumulative returns of over 40,000%, okay? While gold's cumulative returns have only been about 8,500% over the past 100 years. That is a large, large disparity between those two sets of returns. So on an annualized basis, the S&P has offered approximately 10% annually with reinvested dividends, and gold has offered about 4.5% annually with no income off of them, obviously because there is no intrinsic value to gold. There's no value that you can put on gold that isn't determined simply by supply and demand. So what makes my bold statement of gold not being an investment true? Well, there's no reason to think if I invested in gold today that 30 years from now I would have some satisfactory return in gold. Go look at the gold charts long term. Some investors maybe who have held it for a certain amount of time, or especially prior to the large uptick in prices from 98 to 2008, and then up into the later 2000s. Before that time, gold returns were very, very minuscule over the long term. And so it's just difficult to think that you're going to put money in gold and be able to get a satisfactory return out, be able to get a decent amount of money out over the long term. And once again, these returns are only determined by the demand for gold and the supply of gold in the market over the long term. And so given that a lot of individuals want to use gold as a hedge for inflation, as a hedge for the stock market being very uneasy, the economy being very uncertain. Given that they want to use it as a hedge, well, we've even talked about bonds being able to hedge against the risk in the stock market to a certain extent. And even though bonds can't do that with inflation, typically with generally normal inflation, stocks will increase. And so it's only those crazy high inflation periods, which we haven't seen in a long time, to where gold really takes the stage. And so we remember a minute ago when we were talking about what an investment is and is not. Well, if something is not an investment, it's speculation. So if you remember back to that definition, what they said was the object of a speculator is not to secure a steady return on his money at a good rate of interest, but to profit either by a rise or fall in the price of what they may be speculating in. Well, if you think about it, that's all people are doing when they flock to gold, is they're saying, well, I'm afraid I'm not going to get a return here, so I'm just going to try to profit from the rise in price and profit from the demand in gold. I don't necessarily have a reason to go to gold. I don't have a basis by which gold is a good investment. I don't have a promise of safety that is guaranteed. I don't have a satisfactory return that's guaranteed. I just know that a bunch of other people are going there, so it's what I'm going to do. I'm going to go there. So people try to profit based on sentiment and not on fundamentals, and not on this promise of safety and a steady good long-term return. And so that's the problem that I have with gold, is the fact that given that you can't check both of those boxes definitively, and the fact that people are only looking at the price when they are trying to invest in it, that's a big issue. If they only want to run up in price, then that's a problem. And that's why I really don't like gold as an investment in that way, and to think of gold as an investment, because if gold were a good investment, then why does it not keep up with stocks? Why does it not even keep up with bonds over the long term? Well, the reason is that it's not an investment at all. It just hangs in the balance on what you and I decide to do. And so if in the next market crash, nobody went to gold, well, gold wouldn't go anywhere. Gold wouldn't have any reason to move. But as long as companies are increasing their profits and increasing their revenues and increasing their asset sizes, all these types of things, and distributing capital to investors, well, their value is naturally going to have to increase. Now, yes, that value in the stock market is only based on people buying and or selling. But there's no reasonable basis to say that a company that's growing should remain at the same price. A company that's growing should increase in price. But why should gold increase in price? There's no basis. You can't say that gold is growing or that gold is doing anything special. No, just more people are investing in it when it increases and less people when it decreases. And that's the only basis that people have for investing in gold. Also, and I wanted to save this, so if my argument to this point hasn't been too good as to why it's not an investment, then you can look into this part of the investment definition and be able to say, well, yeah, gold's not an investment. So if you go back to that investment definition one more time, it says an investment operation is one in which upon thorough analysis. Well, how can you do a thorough analysis on something for which there is nothing to analyze? There is nothing to analyze about gold. If you are investing in gold, you are making some kind of macroeconomic decision. You're trying to make a decision based on the broader economy, for which you and I have no way of knowing what the broader economy is going to do in the short term. So you can't thoroughly analyze gold because there is nothing there to thoroughly analyze. It is a feeling. It is I want to run up in price because I don't think these other things are going to do good. That's not a thorough analysis. And so that said, that is even more reason why you can look at gold and be like, well, that's not an investment. I can't analyze it. I don't know if my money's still going to be there, and the returns have not been great over the long term. Those three reasons are why I hang my hat on gold not being and not meeting that definition of an investment.